the clock has hit 10 o'clock. So I'd like to welcome everybody to our webinar today, and thank you for taking the time to be with us. Just to mention, it is a webinar rather than a meeting, which means that you can see and hear me, but that doesn't work the other way around. Now, we do have a list of participants who have logged in, which brings me to my next point, which is CPD. So for anyone who requires CPD and a certificate, they can contact myself or Sean after the event. We will have a Q&A at the end of today's session. So you can submit your question either online using the functionality within Zoom, or alternatively, you can email myself or Sean. I just want to mention one or two quick things. One is there were some recent changes in the Finance Act that affected pensions, which had the effect of elevating the PRSA pension product from what was an unloved and unwanted pension product into potentially now the number one choice in certain situations, especially if you're lucky enough to have a plan for large employer paid contributions, not employee paid. I'm talking about employer paid contributions to your pension fund. Now, I'm going to spare you some more details on that because something more fundamental happened at dinner in my house over the weekend when my sister came to stay. And she said, you know, Owen, I know your job title is a financial advisor. I know you've been doing it for about 20 years. And I've heard you talk about work, but I actually don't know what you do. So somewhat taken aback, I replied with a list, and I mentioned savings plans and child savings plans, and I spoke about deeds of assignment and trusts, and I mentioned Section 73 savings plans and Section 72 whole of life products. I mentioned investment policies, and as I took a breath before I got started on my pension list, she interrupted me and she said, you know, that's just a list of products. I still don't know what you do. I'm guessing you do more than help people with an application form. So that got me thinking and summarizing, what is it that I do? How am I of help or benefit to people? And I boiled it all the way down to two words: strategy and structure. By strategy, I'm talking about helping somebody with their asset allocation decision. How is their money allocated over those 5 asset classes, which are namely cash, bonds, equities, property, and alternatives? So what percentage of your money have you decided to have in each of those 5 asset classes? The second word is structure, and that is to do with how you access those 5 asset classes. For instance, in an investment, you could choose to have an investment policy with a life assurance company, and the growth in that policy will be taxed at 41%, regardless of whether the growth in the fund happened as a result of dividend income or capital gains. Similarly with pensions, and there are a long list of structures you could have there. I mentioned the PRSA. There's also a personal pension, an executive pension, a buyout bond, an ARF. So plenty of decision making to be made there with somebody's strategy and structure. Now, when it comes to investment strategy, the 5 asset classes, and explaining what is going on currently in financial markets, I have heard many speakers over the years, but none better than our first speaker here today. Peter Smith is Investment Director at Aviva Investors, whom are headquartered in London and have assets under management of approximately £350 billion. Peter has worked as an investment analyst, a stockbroker, and a fund manager. And Peter, I look forward to hearing your take on the investment markets, and I want to thank you for the time you're taking to be with us here today.
Great, thanks. Thanks, Owen. Can you hear me okay?
Perfect, yeah.
Perfect. Let me just share my screen. Look, many thanks for asking me to speak today. I suppose over the next 15 or 20 minutes, what I want to briefly cover is really what's happened in markets. Let me just share this screen so you can all see it. Can you guys, everybody see that? Yep. Can you see the presentations up on the screen?
First slide is up. Yeah.
Perfect. Okay. So what I plan to do today, really talk about what's happened in markets, brief review of 2020, and then get into a little bit more detail about what we think is happening in 2023 and what the outlook is. So the first slide I have today paints a pretty torrid picture for investors last year, and you can see on these graphs there's very few of those bars are positive. I suppose when we think about it, for most people who hold a core portfolio of equities and bonds, it was a particularly nasty year, driven mainly by what I'm sure we'll speak about a lot today: inflation. We haven't seen sort of the likes of this type of inflation since the 1970s, and it's had a very material impact on financial markets. Global equities last year, as you see on the graph, were down 13%. But really where the difficulty lay was you had global equities down 13%, but you also had global government bonds, which were also down a similar number, so down about 13%. This is a very, very unusual occurrence where equities and bonds fall to such a degree together at the same time. We haven't seen equities fall by 13% since 2008. We haven't seen bonds, global bonds, fall like this basically throughout history. This is like a 1 in 100 year event. It was, if you think about having a mix of 60% equities, 40% bonds, which is the sort of typical portfolio that people talk about, a 60-40 portfolio, it had its worst year since 1932. So that gives you some indication of how much pressure some investments were under last year. It's hard to find an asset class which actually performed well, but there was one, and I'm sure we're all quite aware of it, which was commodities. And you can see that on that green bar, basically the only green bar on the page. It was a top performing asset class. What I did for this was look at the other side as well. And you can see actually tech stocks, which have been the darling for the last 5 or 10 years, were one of the most sort of underperforming. So you can see the dark blue bar on the far, well, it's the far right on my screen. You can see tech stocks fell considerably last year. The other interesting point for last year, commodities did very well. If you looked at just global energy stocks last year, they were up around 55%. So there were pockets of value last year, but in general, the market fell. So, I mean, that's a brief review of 2020, not the most pleasant for most investors, but we should all be aware, and I have more slides on this later on, that markets in the short term can, you can experience these type of drawdowns and volatile periods. So what's kind of been causing these market jitters? Why are we seeing this volatility in markets at the moment? And really it comes down to one word, which is inflation. Although we've probably seen inflation peak, and I'm sure Seamus will speak later about this with far more authority than me, in many ways, inflation has now sort of come off its peak due to the return to some normality in energy prices. But we do not feel that inflation will continue to fall as much over the coming months as maybe the market has anticipated. If you think about central banks globally have set a target for inflation to be around 2%, and that's their sweet spot. And we are sort of beginning to see this play out in markets where initially at the beginning of the year, they sort of interest rates wouldn't have to rise as much, inflation was on its way down. But I think there is this element of core inflation, which is going to be a lot more sticky. So think about wages, food, services. They are what makes up core inflation. And certainly these are harder things to shift down. When you look at the US, where their unemployment rate earlier this month was now at its lowest in 53 years. So under, that current, will inflation continue to fall to the degree that markets expect? I think there's sort of been a slight change over the last month, where certainly our belief that inflation may be harder to reduce once it gets to that sort of 4 or 5% level. I mean, we've seen figures out this week where from Germany, France, Spain, where inflation actually ticked up slightly. So we're not out of the woods yet. There's going to be more headwinds that hit the market. But I want to concentrate on, there are positives here. We have come down, headline inflation has fallen, and this is just one. This slide here is just basically one slide on shipping container costs from China, just to show where we've come from. And as I kind of mentioned, The good news is that inflation has been coming down and is showing signs of weakness. The slide here kind of shows, as I said, shipping container costs around the world. It shot up during COVID due to increased demand for shipping, shortages, logistical issues. And we have seen this subside, and we can basically see this if I was to show you a graph for lumber, wood, fertilizers, plastic, oil, European gas. We show a similar graph where we see this peak and it coming down. So that's that sort of headline impact on inflation, but certainly it has had a significant reduction in prices, and we've seen a significant reduction in prices over the last number of months. And you can see that this slide would be an interesting way to illustrate that to some degree. So where does all of this lead us to? And it's really, this is what central banks are trying to achieve. This slide here just shows, our view on slower economic growth. And this is basically what central banks are trying to do. They're trying to manage economic growth, to slow it to some degree that lowers inflation. And to do this, we have to expect that at some stage, we will see some sort of recession, whether that's in Europe or the US. We must I think it's important, although we believe there'll be some sort of recession in the second half of this year, certainly in the US, we think it'll be a shallow one. And you kind of go back to where consumers and corporate balance sheets are right now, and they're in a much stronger place than if we go back to sort of 08 during other previous recessions, where there was that very, very heavy credit crunch. Balance sheets of family balance sheets and also corporates are in a much better place, and therefore our belief is, yes, we may see recessions over the next 12 months, but we think that be relatively shallow, relatively short. So that's a positive in a way, knowing where interest rate rises will and will probably lead us to, and what the interest rate, the whole tenet of what interest rates try to do and try to manage that economic growth and slow it down somewhat. The other slide that I just thought would be interesting is show you 4 individuals, which have kind of much of the fate of markets and economies in their hands. From my left to right, Jay Powell of the US Fed, Christine Lagarde at ECB, Andrew Bailey, Bank of England, and Haruhiko Kuroda of Japan. These 4 individuals are really responsible for a lot of what markets are dealing with at the moment. So interest rates have risen significantly over the past year, and they will rise further over the coming months. But the positive news is for investors that markets basically, price in a lot of what we know or what we expect to happen in the future. So, you can see the implied, what I've shown here, those numbers. So you can see under the Jerome Powell's face, a number of 5.4, and that is basically the implied high level that markets have implied that interest rates will hit in the US. And it's the same for ECB. You can see that implied level of what the market calls a terminal rate. So that the highest level of interest rates that's the implied rate that I'm showing on this page. You can see the same 4.8 for the UK. And the interesting part to this is a lot of the pain that we saw last year in bonds was driven by the expectations that these interest rates would rise to these sort of levels. So a lot of the pain that investors have taken in bonds has already occurred. The issue you have is if interest rate expectations continue to have to be pushed higher because inflation hasn't been coming down as expected, you may see these terminal rates increase higher as markets expect interest rates to rise further. So, from an investment perspective, bonds now offer a lot more value than we have seen in the last number of decades. Simply speaking, if you think about a multi-asset portfolio with bond exposure at the beginning of January 2022, that probably had a yield of about 1%. So the income yield the yield on a bond was 1%. It now stands at a yield of about 3.5%. So much better prospects for investors. We've been dealing with fixed income and bonds in a bubble for the last 15 or so years, and certainly now that valuation sort of conundrum has really been addressed to some sort of extent. So that's just a little slide on the four people in the world that have a lot of what happens in markets, and that fate of the markets really lies in their hands. To me, when I think about how markets, how markets are viewing things, there's really a trilogy of events happening out there that markets are trying to grasp. And the problem for me is they all can't be addressed at the same time. So central banks are trying to grapple with inflation by raising interest rates, but the consequence of this is that it negatively affects economic growth. So the sequencing of these events and the issues will be kind of key to markets in 2023. And much of the crux of the problem is how these sequencing events happen and sort of wind out in the market. So do central banks keep their foot on the interest rate accelerator as they attempt to deal with inflation, even to the detriment of global economies, possibly pushing them into recession? So these are things that they have to consider. So this trilogy of events are very much interlinked. And from an investment markets perspective, it is how we move through these issues that will determine market returns in 2023. I have a slide on my next slide. It really shows global equities. Global equities since the beginning of 2022. I want to cover these. The next two slides are global equities and global bonds. Cover them in a relatively brief time. First one here, global equities. Really, what I'm showing here is a graph. This is up to the end of February, so it's updated to the end of this month. And given the volatility, it really shows the volatility of markets. You can see those up and downs, the swings that we've seen. All these different factors at play. What we've seen in 2023 is a pretty strong rebound. You can see I've sort of shown that highlighted area, which is basically market since the beginning of the year. They're up around 5%. Very strong month in January. They were slightly down in February, but these ups and downs and what we call volatility is part and parcel of investing. We still believe, as a house of Aviva investors, equities are that growth engine for the medium to long-term investor. Providing a return over the past number of years of 7.5%. If you think from an investment point of view, over the last, actually, when we think about it, over the last 30 years, an equity, global equities have returned about 7.5% over the last 30 years per annum. That basically means that your money is doubling every 10 years. Yes, we're going to get periods like I'm showing on this page where you will see volatility, falls in equity markets, but certainly over the long term, we still believe they are the growth engine for any investor looking to grow their investment. The next slide I have, really, I think this is really interesting. What I'm showing here is global bond performance on a calendar basis over the past 22 years. So you can see that last year was a clear outlier from a performance perspective. It was that sort of, as I said already, that 1 in 100 year event. You have to go back it's basically in the US, hundreds of years to see a similar year where bonds performed so badly. And we have certainly kind of seen, as I said, those bond valuations as a result of what happened last year. Those bond valuations now improve and now offer, I suppose, within a basket, a multi-asset portfolio of different, as Owen said, different asset classes. Bonds now offer better value. They offer a yield which they didn't offer, last year, and they still offer some sort of protection. So as we look through what's going to happen, in the US, certainly interest rates are on the rise at the moment, but the market has been pricing in 12 months' time that interest rates may fall. That the inverse relationship with interest rates for bonds is bond values tend to go up when interest rates fall. So it still offers that, bonds still offer that protection. There is a very strong reason to still use them within a multi-asset portfolio, and they remain for us a crucial element of our investment portfolios. But I thought this graph is really interesting to show what an outlier last year was in relation to global bonds. If you were to look at that at European bonds, US bonds, you'll see a very, very similar picture, but just an interesting take on where we believe bonds are currently. The next slide I have really just talks about, and Owen said this, what's our view on equities, bonds, alternatives, that, property, cash. Markets, as I mentioned already, markets in general are forward-looking. So in other words, they take into account current market concerns and tend to price looking further into the future. So we may talk about looming shallow recessions or lower company earnings, but markets tend to look beyond that. So our view on equities is somewhat, right now, rather neutral, especially now we've seen that, as I mentioned, that 5% rise in equities since the beginning of the year. We believe they make up a very core element of a growth portfolio, but our view, whether we're underweight or overweight or how we view equities, given the 5% rise we've seen this year, and actually from October of last year, we've seen quite a comeback in equities, and we believe we kind of have a more neutral position on equities. That said, I think going forward, it's difficult to see the returns of the past decade reoccurring, where equities over the past decade, on average, each year have posted double-digit returns. And this kind of leads me on to sort of talking about other asset classes. Why do I say that we probably won't see those type of returns? Well, we went through a period where markets coined an acronym, and that acronym was TINA, and it stood for there is no alternative. And that no alternative was there's no alternative to equities. For a number of years, investors couldn't find a return or an income or a yield in any other asset classes. So when I say at the top of this page, changing market structures, they're changed last year, they're continuing to change, where once there was no yield to be found in other asset classes like bonds or cash, it's now being addressed to some extent, where investors can now find a yield in US government bonds of 3.5% to 4%. They can find a yield in cash of 1% to 2%. And I realize this is in a real world where we're still thinking about inflation, but bonds and alternatives will play a bigger part in people's investment portfolios over the coming years. To briefly touch on some of our more sort of views on what we like and don't like as an investment manager, if I take the likes first, I've just listed 3 likes. So on the equity side, we favor areas that are sort of offer defensive characteristics, strong fundamentals, resilient to current market conditions. So this means we favor US healthcare, European energy, UK equities, all exhibit these type of characteristics. We hold a higher weight to cash as a more defensive way of deploying money quickly if we see value becoming available in the market. And lastly, on the plus side, it's important to have investments allocated to uncorrelated assets. So those alternative assets that I spoke about, absolute return, property, for a long-term investor are key differing return streams for investors. On the negatives, we've spoken about bonds quite a bit, torrid year last year. One area that hasn't really pivoted to that sort of tightening type regime is Japan. So we're pretty wary that they will do at some stage. Inflation's picked up, and even in Japan is up to 4 or 5%. So we think they will begin to pivot. So we don't see any value in Japanese bonds. European equities, we think we can find better value in and preference to other regions, and prefer sort of pockets of the market that offer value. And on the currency side, US dollar had a really strong 9 months of 2022, sort of reaching and breaking parity with the euro. We feel the factors that supported this have now faded and have subsided. So not as positive on the dollar as we would have been. The last number of slides, and I'm just conscious of time here. The last number of slides, I wanted to concentrate on one of the funds that we have within our stable that has weathered the recent storms very well. And this has been our high yield equity fund. It really helps illustrate the importance of income within a portfolio. So this fund basically invests in companies globally which have a strong dividend. They produce a strong income. Companies that we focus on companies with strong balance sheets, that have cash generative businesses, that are growing their dividend. And these type of companies tend to offer resilience when markets fall. Companies that the fund invests in tend to offer sort of pricing power, and some sort of hedge against inflation. And I've just given some names there. When you think about Visa, it's growing in emerging markets, but the pricing power it has and that hedge is obviously it's based on the value of transactions. So from an inflationary point of view, there is some sort of hedge there against inflation. And these defensive type of companies in that second column in the middle, you can see performed really well during market stresses. Last year, this fund, the market The equity market in general was down, as I said, about 13%. This fund was down about 2.5%. So providing that resilience, providing that protection. And crucially for me, because the fund is well diversified, it's not just during market stresses that the fund does well. It's got a really, really good long-term track record, provided excess returns of over 1.5% or about 1.2% per annum, as you can see in that last column over the past 10 years. So it's worked very well, both in markets when markets are stressed, but it's also, stood the test of time when we've seen markets rally too. And you can see that over that long-term number. The last two slides I want to speak about are more sort of behavioral aspects. And I speak a lot about our views on markets, short term. But it's funny, Owen was mentioning this, during last week, I have a teenage daughter, 16, moody teenage daughter, came out with this show-stopping comment to me out of nowhere. And as I say, I don't think she knows anything about what I do, or I didn't think. But she says, Dad, if shares in the long run go up, which you always say you've seen that they do, why do people sell them at the worst times? And she just came out with this at the dinner table, and it kind of got me to think, and this is one of my favorite slides on this page, and it kind of leads me on to this. The light blue periods in that first graph along the top of the page are the crisis points in history when markets have fallen. You can see that last crisis point was COVID, when markets fell. You can see 2007 to 2008, markets fell, to a huge degree at one point. But what's really, really important to point out is the second graph below it in those dark blue columns is really how the market reacted in the following 12 months once those markets had hit bottom. So in the following 12 months after the market had hit bottom, you can see over all of these time periods, there was this big rebound. So my take on this is it is so important that people don't miss out and people stay patient and stay invested in markets. If that's your long-term plan, equities over the long term have shown to produce a very, very strong growth pattern. And you can go back over long periods to see this. The problem we have is the behavioral aspect of people probably selling out at the worst time. And this graph here just illustrates the point that when we go through a crisis point, very difficult to time it right to get back into markets. But what you see is these strong rebounds following the market hitting that low point. And there's no other graph that shows this to more of an impact than the one I have here, which really basically shows, if you invested 10,000 euros in 1988 and had remained invested for the entire time, you would have now 330,000 euros. So if you had invested in the S&P 500, I use this because the data is just more reliable going back over longer time periods. And so that's over 34 years, 12,500, pretty much 12,500 days, you would have made 330,000. If you missed, and this is an incredible stat, if you'd missed the top 5 days, so 5 days out of that 12,500 days, your investment would have fallen by about 120,000. So it goes from 330 to 210. And that is just missing 5 days. You can see as that goes along, your investment falls further. But just to finish off with what I talk about markets and all of that entails, just to show you the impact of staying patient, staying with the plan, and staying invested is crucial for any investor. And that is where I will leave my my presentation. I hope that's been useful, and happy to take questions at the end. Back to you, Owen.
Yeah.
Okay, back to me.
Yeah, it's back to Sean.
Okay,
Sean.
thank you very much, Peter, for your great insight and knowledge there. The audience will appreciate what you how well you've explained it. I'm going to pass this over now to Seamus Coffey, economics lecturer in UCC, who has also equally a great man for explaining and great style. So over to you, Seamus.
Well, thanks very much, Sean. So I'm just going to share my screen once it's possible to do so. There we go. And get the slides up. Yeah, so thanks very much for the invitation to speak here this morning. What I'm going to offer maybe is a compliment to what Peter has gone through for the last quarter of an hour or so there, and look at maybe much the same issues, but from an Irish perspective, and to see maybe what changes we're seeing from these global international factors on Ireland, on the Irish sort of macroeconomic position, again, perhaps with a focus on inflation, looking at interest rates and what they might tell us both domestically and internationally, and then maybe look at some Irish specific issues that arise, trying to give a focus on the investing side, but again, looking at sort of the broader macroeconomy. So we'll give a passing reference to housing from time to time, and just in terms of resources, we look at the impact that the energy prices have had at an overall level, and maybe from a positive, from an Irish perspective, we'll close with a look at corporation tax and maybe some of the choices we face with the money Ireland is collecting from corporation tax. So as I said, the focus will be on some issues. I think everybody has a theme of turbulence or uncertainty, and we clearly are in turbulent times, but in off-camera discussion earlier on, I was saying, when weren't we in turbulent times? So from an international perspective and an Irish perspective, one of the key driving factors has been inflation. And we really have gone through an extraordinary period of inflation over the last number of years. And it's not that period at the right-hand side of the graph where the line seems to go up vertically. It was the 7 or 8 years before that where inflation was close to zero. And you can see the Irish green line crossing over and back at the zero, that red dash line repeatedly. Up to the pandemic in early 2020 turned negative, and now for a variety of factors has shot up. Now there is a lot of interest in what's happened to the very last data point there, that being the flash estimate of inflation for Ireland, the euro area for 2020. The CSO published the Irish figure yesterday, and it drew some raised eyebrows with this increase in inflation, and Eurostat have just published this morning the flash estimate of inflation for the euro area. It was possibly felt that given the numbers that came out of Ireland, Greece, France yesterday, or Germany and France yesterday, it might point to an increase. Actually, it's showing inflation in February to relatively flat, going from 8.6 to 8.5. But it was expected, and we'll come back to the impact of this, that inflation had peaked and would continue on that downward trajectory. You can see from about late last year, the rate of inflation falling. So the last couple of days has maybe dented the expectation that inflation is about to drop, not perhaps as steeply as it rose, but to drop significantly through 2023. Now, I wouldn't read a whole lot into it. It is just one data point, and you can see with the series are pretty lumpy. I think we need more before we can be concrete in what's happening to inflation. Has food price inflation taken over from energy price inflation? But it is something that's been looked at. But I think what we take from this is that the rapid rise of inflation over the past 12 months is what's dominating the sort of international environment. And as Peter went through, changes when it comes to interest rates. And they'll be the key. When it looks at interest rates, we can see what the ECB has done over its history. And looking again at the most recent changes, you're going from mid-2022, where the key ECB rate was 0, and we're now heading for 3%. And of course, they've already announced that at their meeting this month, in a couple of weeks, there will be another 0.5 percentage point of an increase, and maybe they'll give further forward guidance on what they'll do during the rest of 2023. But again, to say like what is unprecedented is the increase we're going through now unprecedented? No, the unprecedented period was what happened between 2016 and 2022 with those rates of 0. Again, as Peter said, you can go back centuries for countries which we have data that period was exceptional. Although the increase is very rapid now, we are perhaps moving back to more normal interest rates, but it certainly is having an impact. But maybe again, focus on an Irish context, maybe we're not quite yet seeing the changes in interest rates on both the borrowing and the lending side and the depositing side from an Irish perspective. And we might be wondering that. We'll come to deposits in Ireland in due course. And people might be saying, well, given what we showed there with a very steep rise in base ECB interest rates, why aren't we seeing that passing through to deposit rates? And one reason is that we actually have seen little pass through yet in an Irish context from interest rates. So this is across the euro area, lending for house purchase. This is pure new lending. So a new customer comes into a bank for a purchase and is looking to draw down a mortgage. And Ireland stands out there, that green line, it stands out before the pandemic as being one of the highest interest rates in the euro area. So you can see we were vying with Greece for top spot amongst this group of countries. We were close to 3% for new mortgage lending, whereas the euro area average was below 1.5%. But you can see what's happened in the past 12 to 18 months. Almost all other countries have risen in line perhaps with the ECB and general interest rate environment. But actually yet in Ireland, we haven't seen that. We're beginning to see it maybe in December. But if you look during 2022, the lending interest rate in Ireland actually fell, and counter to what was happening with the ECB rate. Now, I think we will see that interest rate pass through. And it's not as if the banks have been overly generous in an Irish context. If we were to look at deposit rates across the euro area, we see that in most countries they have risen. So bank margins haven't increased across the euro area. In Ireland, they've kept deposit rates at close to zero. So again, they've maintained their margin. They haven't really changed the rates on either side. Now, some borrowing rates have changed, tracker rates, etc. But this is for new lending, with the majority of that done currently at a fixed rate. So this is an average or blended rate across the activities of the bank. But it is sort of unusual to see Ireland going from the highest in this group of countries in early 2020 to now down towards the lowest, below the euro area average, and with France, the only country in this group to be below it. So if you're looking at interest rates in Ireland and saying, I'm not quite seeing this international effect carrying through, we haven't seen it yet. I think we will see some of it with increases in lending rates. Not so sure about the deposit rates. We will wait to see. Sticking with interest rates, and not wanting to get hugely technical, but just what can interest rates tell us about the future, and maybe why have they changed? This is a yield curve for Irish government bonds. So what is a yield curve? It's looking at the yields, the return you get for holding Irish government bonds, whether that's just for 1 year, you buy the bond now and it will mature in 12 months' time, or all the way out to 30 years. You buy a very long-term Irish government bond that won't mature for 30 years. And given the price and given the coupon, we can work out what your sort of annual return would be on that asset. And we can look at this yield curve over that range from 1 year to 30 years over a number of different periods. And going back to 6 months ago, this is a pretty standard yield curve. This is what we might expect to see. That if you were lending money to the Irish government for 1 year, compared to lending money to the Irish government for 30 years, you would expect a lower return for 1 year. Surely we have more knowledge about what's going to happen over the next 12 months than what will happen over the next 30 years. So if you're going to lend for 30 years, you'd expect a higher return. There's more risk, there's more uncertainty. You don't know what the government will do. You don't know what the international environment will do. And of course, you don't know what's going to happen to your own circumstances. So that yield curve in green from 6 months ago, towards the third quarter of 2022 is typically what we expect. It's upward sloping, lower rates at shorter maturities, extending out to higher rates at longer maturities. But if we've seen what's happened in the past while, some of this sort of conventional wisdom seems to be flipped in its head, particularly if we look at the yield curve for a month ago, that red line, and particularly over the period 1 to 3 years. Look right at the left-hand side there. You can see the return, the yield for 1 year was around 2.5%, whereas the yield for 3 years was below that at about 2.25, 2.3%. And this is what we refer to as an inverted yield curve, that short-term rates are higher than longer-term rates. And we wouldn't expect this at all, given this idea that we should know more about the current environment than the future environment. But what was the expectation maybe a month ago? That interest rates had risen very rapidly and were higher in the current time, in the near term, than they would have been out over the medium term. That the expectation was that interest rates in years 3, 4, 5, and 6 will actually be lower than they would be now, that inflation has peaked. You could also view this sort of inversion or downward slope of the yield curve as being an expectation of recession. But I think we have a bit of a a dual sort of explanation for this. One linked to inflation and belief that, it had peaked and that interest rates might actually fall. And then a second perhaps linked to the impact of a potential recession. But that inverted yield curve a month ago would have raised a few eyebrows, that the expectation was that interest rates in 3 or 4 years' time would be lower than they were now, and returns for investing in 3 or 4 years are lower than they would be for investing for 1 or 2 years. But if you look where we are now, so this is the yield curve as of yesterday, we can see that it's flattened out a bit. So those expectations have changed. This view that interest rates would be lower in 3 or 4 years' time has moderated a bit. Now, the yield curve is still unusual. It's not our standard shape, which we started off with the green one of 6 months ago, but it is flattening out. So that means that perhaps the expectation of lower interest rates in a couple of years' time has receded a bit. Now, you can, again, apply 2 reasons to that. One, down to inflation. They don't think inflation is going to fall as fast as we've seen, and interest rates will stay higher for longer. Or 2, it could be down to those recessionary fears. But again, it's just a matter of interpretation to which you attribute the changes. But what we're seeing here is those pretty significant changes, particularly over the 1 to out to 4 and 5 years over the last number of months, going from a pretty normal yield curve to an abnormal one a month ago, now to a flatter one, still a bit abnormal, but not as bad in normality terms as it might have been a month ago. What's driving all this? Again, it's back to inflation. This is the same chart again. I think that the view of inflation has perhaps changed, but we do need more observations before we are conclusive. When it comes to energy, what are we looking at? And from, inflation, what are we looking at? And from an Irish perspective, at least up to now, it has been driven very much by energy and the external cost of energy. So when the ECB is changing interest rates and inflation is driven by energy, what impact is it having? And from an Irish perspective, up to the COVID crisis, we typically spent about 4 billion euro, 4,000 million euro a year on our energy imports. We have to import most of our energy. For 2022, that cost over 11 billion. So that is just a huge cost, and that's a net outflow we have from being a fuel importer, and because the cost of it has gone up, we've imported significant amounts of it. If more money is leaving Ireland, where is it going? I'm not saying it's going directly, but one of the European beneficiaries, at least, of these rising energy prices is Norway. And here we look at Norway's balance of payments, the balance of money flowing in and flowing out of a country. Pre-COVID, Norway was in a pretty good position. They used to run an annual balance of payments of around 20 billion euro. So they were in positive, more money flowing into the country than flowing out. Population similar to Ireland. That's about 4,000 euro per capita. But just look what's happened in the last 12 months as energy and particularly gas prices have soared. Norway's balance of payments is hitting for 150 billion euro. In a single year, there's only 5 million of them. That's close to 30,000 euro per capita for the country. And this is a country that already has a sovereign wealth fund worth over $1 trillion. Now, in line with the figures that Peter showed, they suffered a bit of a hammering last year because of their investment in global equity and bond markets. In fact, they lost over $100 billion. But actually, in overall terms, the value of the fund was unchanged last year, even with this huge hits in global equity and bond markets, because they put 100 billion in. They gained 100 billion from their sales of oil and gas. So lots of money leaving Ireland, and one of the winners would be Norway. And if we're looking for a tax on windfall profits, can we tax the Norwegians? Just to give a sort of a domestic feel for where inflation is changing, if we just look at the price of fuel and energy, the price of a litre of diesel seems to have peaked and has fallen over the last six or so months. And the price of milk is going in the other direction. It is rising, and perhaps no indication yet that the price is falling. Now, from an Irish perspective, we import our diesel, whereas we produce the milk. So maybe the increase in the price of milk could lead to additional funds for investment. It's expected that average dairy farm income last year was about 150,000 euro. And much of that is driven by the increase in the price of milk. Then to just conclude a bit looking at money in the Irish economy. The Irish economy is now characterised by savings. So what this chart here is just the net position after spending of governments and households. If it's below zero, you're borrowing. And you can see we did lots of that. The chart goes back to 2000, particularly up to 2006, 2007 with the household sector, then a huge hole in the public finances and the government borrowing. for 10 years or so. But the past 2 years have been characterized by massive savings from an Irish perspective. And now both the government is saving due to these corporation tax receipts it's getting, and households are saving. And we see this in the main as being a build-up in deposits. And we talk about extraordinarily low interest rates in Ireland. And this is an average monthly change in deposits that Irish people have with the Irish banks. And you can see that the increases over the past 2 years have been around €1 billion a month, a huge increase in essentially non-interest earning deposits over quite a short period of time. Now, the most recent observation for January does show it to be negative, but there is a bit of a seasonal pattern to deposits. If you're doing a 3-month average and you're getting as far as January, well, 1, you're including November, when the pay and file self-assessed tax deadlines have been there. 2, you're looking at December, when we do most of our spending. And 3, perhaps you're looking at January, perhaps with January sales. So maybe a reduction in deposits around this time of year isn't that unusual. And we would perhaps expect that sort of average change to increase again. But it does give rise to a position where maybe the most important interest rate from the Irish household perspective is not necessarily that on loans and mortgages, although that is quite significant. It's the interest rate that's available on deposits. And if you look at the household sector balance sheet, we've swings and roundabouts in the last 20 odd years, huge borrowings up to 2008, then repayments, and now in recent times this huge buildup of deposits. And now deposits are significantly more than loans. Between cash and deposits, we have 190 billion. And as I said, that is, most of it is sitting there at zero or near zero rates. Is there something more sophisticated we can do with the deposits we've built up over the past while? One thing that isn't happening is sort of direct investment in property. We've a number of ways of looking at it. One way which we look at mortgage drawdowns for residential investment. Now, it's not the overall pattern. We could have cash purchases. But again, we see Ireland going from swings to roundabouts. The peak 2006 with about 7,000 mortgages a quarter being drawn down after residential investment to these minuscule levels over the last 10 years or so. And in fact, the Payment and Banking Federation has stopped publishing this data at the end of 2021. I think the numbers got too small, and there might be concerns about confidentiality. And we're seeing maybe the consequences of that in our housing market with nowhere to rent. It's simply a function that there are exits. People are getting to different stages of the life cycle and are selling residential investment properties, but we're seeing very few entries to offset those losses. And then let's conclude why I mentioned corporation tax. Well, here are corporation tax receipts per capita across the EU. Even up to 2021, Ireland stood out. A group of EU countries were collecting huge amounts of corporation tax. It was €3,000 per capita in 2021. Not quite the 30,000 that Norway is getting for its oil and gas on a per capita basis. But we can see that we stand out relative to our EU peers. And we just put in the 2022 number. RCT receipts last year were over 20 billion. We have a huge resource to tap into. And what we do with that will be quite important. When you're highlighting risks, and this is the risk you come up with from a financial perspective, it's an odd one. This is the best risk a Minister for Finance could ever face. I'm collecting too much tax revenue from a particular source, but it certainly is there, and the amounts are pretty similar. So are we closer to these calmer waters? Hard to know. There are tentative signs of inflation easing, but maybe some concerns about the most recent figures. Energy prices certainly are falling, but uncertainties remain. I think the rate tightening will continue for a while. But we certainly are closer to the end of that than the beginning. And from an Irish perspective, in overall terms, like, should we be saving 30 billion a year between households and government? Corporation tax continues to soar, and that's certainly a risk. And there's no doubt that we need more housing. Thank you very much.
Great. So thank you, Seamus. It's a testament to your personality and presentation style. That was very interesting, far more interesting than I recall being in UCC listening to economics lecturers, granted about 33, 35 years ago. But thank you very much for that. That was very engaging. If anyone has any questions, please submit them. I have one question for each of you if we don't get any other questions. So Peter, I would ask you, when it comes to, say, a pension investor, so let's take the example, they have decades to go to normal retirement age. Even after that, they might choose the ARF, which might keep them invested for another couple of decades. So they really meet the definition of a long-term investor. Okay.
Mm-hmm.
Would it be fair for me to say that their choice of investment strategy would be a bit of a no-brainer, in that they should just take on plenty of equities, they're contributing every month, and that's it? It probably is as simple as that in that situation.
Yeah, I mean, I think as I showed there, those sort of long-term numbers, I did a presentation on this relatively recently, and when you look at those long-term numbers and where you're going to get growth as an investor, you know, global equities have been that place to go. I did say during my presentation that, you know, I think the expectation of double-digit sort of equity growth that we've seen over the last 10 years is going to come down somewhat, but still sort of that 7 to 8% that we've seen annualized over the last 30, 50 years in global equities does stand to that whole reason that, you know, equities are that growth driver within a portfolio. Yet I would say on the other side, it's important to have diversification in there in any portfolio to weather those storms that you face. So I mean, you spoke about at the very beginning about, you know, all the different asset classes. When we build even a long-term growth portfolio for a client, it's going to have, yes, it's going to have, you know, 70, 80, 90% in equities, but there is going to be some sort of counterbalance to that for a certain percentage of the portfolio. So yes, equities for me personally, and when you look back over time, certainly offer that growth engine for any investor.
Yeah, I have you. No, thank you. And Seamus, I know you were chair of the Irish Fiscal Advisory Council, and you got, I listened to you many times on Prime Time and all those types of shows. Do you feel that the information you gave, do you feel that that was acted on, as in politically, or?
To a certain extent, actually, yes. And I think, was it as a result of having a fiscal council? Maybe you could attribute some to it. But I think from an Irish perspective, a lot of it would have been the scars of the crash. Just the devastation caused by getting the economy out of whack in the run up to 2007, 2008. We can all see it in retrospect, but there wasn't enough sort of a view of the risks that were there at the time when it came to reliance on construction, on housing, reliance on stamp duty, and sort of keeping a bit of a balance to the public finances. And like what we've seen over the past while in the other direction is just how important the public finances can be. Because one thing we've gone through various crises over the last 24 to 36 months is that the public finances have been in a position to step in. Like when huge swathes of the economy were shut down in the first quarter of 2020, the government offered support to households, to those who couldn't go to work, to businesses, and spend billions of euro. And if they didn't have the capacity to do that, we'd have had the COVID crisis and then an economic and financial crisis, one on top of the other. And even with the increase in inflation, we've seen the government able to step in and respond. Now, there is a bit of a contradiction. Peter went through why central banks are increasing interest rates to try and take some of the demand and heat out of the economy, to try and bring down inflation. And then you get ministers and various governments announcing billions of euro worth of spending packages to offset the cost of living crisis, in a sense, stoking up demand. So we do have this bit of a disconnect between monetary and fiscal policy. I think a fiscal council would only be focused on the fiscal side of it. From an Irish perspective, we're not in bad shape. Yes, a lot of this is down to the huge corporation tax receipts we're getting, but better to be getting those than not.
No, thank you. Peter Pierce has just sent a message there, and he mentions no mention of climate change. So Peter, I'm thinking there has been quite a lot of developments with products and classifications and climate change and the positive change there. Do you mind mentioning?
Yeah, absolutely. I mean, the products that we offer now, the EU regulation basically brought into play something called SFDR, which is basically the categorization of investment funds that are available in the retail market. So, and they've classified it based on how much they're taking into account environmental, social, and governance issues. So from our point of view within Aviva Investors, all of our funds that we now offer are sort of what we call light green. So they have they consider ESG within their investment process, and we basically tilt our investments to better companies that have better ESG characteristics to some extent. We also have a baseline exclusion policy where we don't invest in certain industries like coal and tobacco. And then the third element of that, which is one of the reasons EU regulation came into play in the first place, was basically for investment managers globally who manage, you know, trillions and trillions of dollars of their clients' money, for them to put more pressure on the companies that they hold shares in. And this is what we call engagement, stewardship, active stewardship. So basically we're engaging, speaking with and working with the companies that we own as a shareholder due to the monies that we get in from our underlying customers, and we use our voice basically to try and encourage these companies to take action. And a lot of what the EU regulation was trying to do was exactly that, and it's beginning to have an impact. So, you know, we have what we call a climate engagement policy. So for the top 30 companies in the world that produce the 30% of climate of carbon emissions, we basically are engaging with those top 30 companies, giving them a certain period of time for them to change or to encourage them to change. And if some of these companies don't, we'll basically sell out of those companies. So you're using your voice, you're using your shareholding to encourage these companies to change. And it works. So there's lots of stories, not for today's call, but there's lots of stories where we've worked with the likes of BP or worked with the likes of Unilever or Meta or whoever to encourage them to change their business process to take into account environmental, social, and governance issues.
Okay, no, thank you. And there was just another question here, and it said no mention of Ukraine. So Seamus, I'm thinking, when you showed us the balance of payments for Norway and this lovely idea that could take hold of tax the Norwegians, I can see that one on a poster somewhere. Yeah, I presume that ties in. I presume that point that's down to Ukraine and what's the troubles going on there.
Oh yeah, so while no explicit mention of Ukraine, a lot of what we're seeing, particularly in European energy markets, is directly related to the geopolitical tensions, the fact that European countries have imposed sanctions and stopped fuel imports from Russia has had huge consequences, particularly on European energy prices. You can compare gas prices between Europe and the US, and they're very different. And one of it is just down to the differences in supply and demand. Now, actually, things turned out to be relatively okay this winter. If you go back to last August, there'll be talks of, can European gas reserves be topped up? Can we store sufficient? Can we get through the winter without blackouts? From an Irish perspective, we were worried about whether the wind would blow, but from a European perspective, it was about whether there would be enough gas. And I think now, as we're at the start of March, it does look like we've come through the winter heating season relatively unscathed in terms of actual supply and quantity of gas, although we're going through a bit of a cold snap at the moment. So I do think while there was no direct and explicit mention of Ukraine, a lot of what we're seeing is directly down to, and what happens there will have an impact. And it has, as we know, been the key driver of inflation thus far has been energy. Whether it passes on to those second round effects that central banks are fearful of is yet to be seen. But I think to say that Ukraine wasn't part of, I think, any chart of inflation or any chart of energy is looking at the consequences of the conflict in Ukraine, even if not mentioned explicitly.
Okay, thank you. And Seamus, one for you here again. How would Seamus marry the cost of the living crisis versus the huge savings ratio we also have? Is it that there's a huge divide, for example, between those who have to rent and those who are homeowners?
Great question. And it's clearly obvious from the figures that there is some sort of huge difference between the lived experience of individuals. When you look at aggregate figures and you're talking about bank deposits going up by €1 billion a month, that can't be everybody. It isn't everybody. There is a certain cohort out there that are in an income surplus position and are seeing those bank deposits build up. Now, we don't have great insight into the distribution of that, but you'd imagine that it would be perhaps older people, those people that have smaller or paid off mortgages, owner-occupiers at a certain stage of life. Whereas those that are struggling are clearly those that are renting. There is nowhere to rent, and the price of rents are astronomical. You talk to them about rising deposits, and they look at you askew. So I think a younger cohort struggling with renting and perhaps getting into the benefits of being an owner-occupier. In an Irish context, we have lots of instances of insiders and outsiders, and our housing sector certainly is an insider-outsider situation, where those on the inside are owner-occupiers with older, smaller mortgages, even social housing tenants with fixed housing costs relative to their income, whereas those on the outside are those in the private rental sector. And there doesn't seem to be any efforts made to address that where our problems are most acute. In fact, we continually see policies favouring owner-occupiers, calls for increased social and affordable housing, but nothing for private renters. And I think going back to this divide we see in the figures, like who is building up these huge deposits versus the cost of living crisis with rents, etc. And the housing is very much a domestic factor. We can't blame Ukraine or Vladimir Putin for Ireland's problems with houses and the huge increase in rents. So I think there is this division here, and it is something that needs addressing. But if policy is focused on owner-occupiers and social and affordable housing, I'm not sure where the solution for the private renting tenants are going to arise, because renting is a legitimate form of tenure. People do it because they move to a country or because of the stage of the life they're in. But we seem to be a case of watching the rental sector shrink before our eyes, and these people have nowhere to go.
No, thank you. So I'll leave this as the last question, even though there are others, but it's 11 o'clock. So the last question goes to Peter. Peter's slide about investing 10,000 in 1988. You'd end up with 330,000 in 2022. I get this point about not selling and leaving it there. What I missed was the part of missing the best 5 days. Does this mean if you sold on the mornings of the best 5 days, you would be that much worse off? Could you ask Peter to just explain that point again?
Yeah, I mean, so the data there, basically what I've done is just removed the best 5 performing days. And I suppose what I'm trying to get through there is I can't tell you when those days are going to be. And if I could, I wouldn't be here. So, you know, it's just an illustration of staying invested, because we don't know when those best 5 days will be. And if you take those out, that's the impact you have on your investment. So it's about staying patient, staying in markets and staying invested.
Sure, perfect. No, thank you. Okay, listen, thank you, everyone. Thanks to all our speakers. Thanks to all our participants here today. And there will be a recording made available, and if you have any questions that you think of, you can email myself or Sean and we'll get them answered for you. Okay, thank you everybody. Have a good day.
Thank you.